Good day, everyone. Well, we are at the end of the year here, and the year has been one of the most challenging, trendless, choppy years that we've seen in ages. Hedge funds have taken it on the chin. I think it's one of the worst performing years in a long time. And even we look at the trend following wizards, which are tracked. That's a collection of top traders who have been interviewed in market wizard type books. They've been running hedge funds for at least several years, if not longer. And it looks like this year, well, as of November 30th anyway, they are collectively down once again for the year. This QE nonsense has really thrown a wrench into the tool shed here, because I do remember 2011 and 2012, these guys a lot of them were down double digits for the year. And these are guys who are used to well outperforming 99.99% of fund managers. So, with all this manipulation going on, it's invalidated many tried and true indicators. We noticed that in 2009 when QE was established, we've had to consequently create new strategies as the markets always change. They never stay static. The only thing that doesn't change is change. So selling into strength in context with the stocks chart, keeping stops extra tight that we illustrated in some of our recent weekly reports, that's been essential. And by keeping those stops extra tight, such as using a penetration of a moving average, means that your losses can be kept to within a couple percent. So if you do get a gain of, say, 10% or more, that easily offsets those few small losses. The whole year hasn't been this challenging. I mean, the first half of the year, we had a number of great names come through, like AMBA, SUPN, SKX, and some others that were very nicely profitable to the tune of 30% or more. And unfortunately, since mid-June, or rather just since the middle of the year, the pickings have been slim. Part of the issue has been that the fall in junk bonds have accelerated starting June of this year. And that has put pressure on the general stock market, much as it did in 2007 and 2008 before that big crash. And I noticed that when junk bonds have a sharp sell-off, it takes the stock market along with it, and the correlation is quite high. It's almost
hey, Dr. K.
Yeah.
Is there a nice high yield ETF, high yield bond ETF?
HYG. If you put that one up, then compare that. HYG.
HYG.
Hairy yellow. Yeah, hairy yellow green. And that's a chart of junk bonds, and if you compare that to the S&P, for instance, the S&P 500, and you can see this year that the fall has accelerated in the second half of this year, and when you compare that against the S&P, you'll notice that when HYG takes a tumble, the markets do as well. But yeah, it's interesting because I think a lot of analysts are concerned, and perhaps rightfully so, that now that the Fed has raised rates, and now that their dot plot suggests that the Fed will hike rates a few times in 2016, that could be the pin that bursts this junk bond bubble. We have a junk bond bubble simply because interest rates have been at all-time historical lows for a number of years. So there's been a lot of money that's been lent at these very low prices, especially emerging markets have undertaken many of these loans. So if the Fed were to start raising rates, even one or two more times in 2016, that could create a potential problem, and it wouldn't be hard to see how indices like HYG, these junk bond tracked indices, could end up having serious corrections. and that in turn would probably precipitate corrections in the stock market, the U.S. market, and since all the world markets follow the direction of the U.S. market, that of course would create a waterfall effect globally. And meanwhile, there's oil and other commodities are continuing their slide, which puts further pressure on stock markets. QE has been not it's not resuscitating that global demand. It's been central banks have been at this with the U.S. Federal Reserve first in 2009, and it's a very tenuous situation. One of the most by a threat situations I think we've been in a long time. And despite this fragile situation we're in, governments continue to raise taxes, which is often the final nail in this economic coffin. Major world governments are doing everything they can to extract as much tax as possible from their citizens. And there's stories, headline news. You can Google this stuff. The U.S. is putting pressure, or they've actually forced the Swiss government now to hand over all their private records of those who keep, they keep valuables in their warehouses in Switzerland. The Chinese are known for doing that because they'll buy at prices works of art for millions, and then they will store them in these warehouses. And it's one way to get money out of the country, because China has I think a 50,000 US dollar equivalent maximum that any Chinese citizen can move out of the country. And then you got countries like Australia who are seeking taxes by way of the children, the students. They look at students going to the most expensive schools, and then they target the parents, who are assumed to have money because they can afford to send their kids to such expensive private schools. So this is all sounding pretty dire, I know, but the silver lining is that the Fed has hiked rates for the first time in a decade. So they may no longer be on the QE bandwagon, and their dot plot, if it proves any accuracy at all, then with more rate hikes, we may get that popping of the bubble, and that may induce a correction or a crash or a serious bear market, which is long overdue. And I think that'll be equivalent to hitting the reset button on the markets overall. And that would be a good thing, because then maybe, just maybe, we can start in again on more normal market behavior. I mean, there is no such thing as normal, I suppose, but at least what we've seen, since 2009 can be wiped away, and we can start on a clean slate. So, these challenging times are great. The other silver lining here, besides the potential bear market, is that, much as a post-dot-com bubble, that created an environment in 2004, 2005, 2006 where race breakouts and canceling type names just weren't working. And that's where I came up with the pocket pivot and viable gap up concept in 2004, then really put it to test in 2005. And so, these troubled times can yield a lot of great treasures in the way of research findings. And much as this year has been so volatile and trendless, the VIX volatility model, which had started about 2-3 years ago as a day trading model, actually was transformed into what it is right now. Because I noticed that even though this year was so hard to make profits, especially trying to market at the time, the volatility model, and I don't like calling it a model, because it's really a self-learning strategy that learns as new data comes into the model. But this year, up through about August, the model was up hugely, just by capitalizing on these volatile moves. And meanwhile, the drawdowns were very limited, so the risk-reward was astounding. And I've been very excited about this model, and fail-safes have been incorporated during the beta phase. So those have been very worthwhile in terms of hugely minimizing the risk side. As members may notice, some of these losses are closed in at either break-even or 1% losses. Meanwhile, as you can see, the last couple signals, the gains can be easily 3, 4, 4 or 5% or more. In fact, as some may remember, early on before the failed safes, there was a signal where I think in one day the profits were over 20%. So time to tell, of course, now that we're in real time, and once the model has a few more good signals under its belt, it will go properly live. But in the meantime, we will continue to email out these real-time reports to members so that they can try their hand trading on the signals. The 2016 is looking more and more. I don't like to make predictions because the future doesn't exist. But that said, it seems to me that we're reaching much more of a tipping point with regards to the corners that central banks have painted themselves into, meaning that as the Fed, say, starts to hike rates, we could get a popping of some of these bubbles that have emerged. And that means simply that we will potentially see a lot more volatility in 2016 than we have in a number of years. And volatility, of course, can translate into great profit opportunities, much as 2008 was a great year for a market direction model. 2011 was as well, especially after June when the market just went into this very volatile, but it was a non-chaotic volatility, if that makes sense. In other words, the model is able to pick out the buy and sell signals and be very profitable from volatile environments like that. So yeah, stay tuned for 2016. I'm very excited going into this year, of course, do as always. Right now, we're still in a very uncertain period, so keep your stops extra tight, and we will continue to make out these weekly reports as they come through on pocket pivots and bottom gap ups. I think this week, I don't think we've had really anything that's worth discussing in the way of stocks. Of course, volatility is maybe a little more exaggerated because of the end of the year where institutions are on holiday. But at any rate, I will now turn it over to Gil.
Yeah, so far the market's acting like it did right at the end of 2014. The last 2 days before New Year's Day, we sold off. You look at the NASDAQ going back to, where are we here? This would be right here. Let's see. Right here, we sold off the last 2 days of the year, and then we started out the year with the 3-day slide to the downside, which resulted in more choppy action, and it's pretty much where you are right now. It seems like markets are going back and forth, chopping sideways. There's no real resolution, and I think for the most part, the way to make money in 2015, in hindsight, was to just buy the ugly ducklings. When the market got so damn ugly and things started to look like they were just going to blow apart, you basically had to step in and take a shot. If you look at any of the indexes, and I can run through all of the major indexes here for the year, roughly a year long. This is beginning of January on the left side, up to the current phase here in December, where we're just chopping back and forth along the highs. But really, you went nowhere. But you just had this dropout in the middle of the year, right after July. And that you had to buy into. That was the best uptrend. So you actually saw the same thing occurring in a lot of stocks. The best moves occurred in individual stocks that had broken down and bottomed or sold off sharply and then rallied back up. Now, I'm not sure who in their right mind would necessarily want to buy into something like we saw back in late August, because you can look back at a lot of these patterns and the action. And chime in if you got anything to say about this, Dr. Caven. From my perspective, sometimes the action almost seems to be the opposite of the outcome. In other words, you'll see ugly action occur for a few days, which seems to indicate that further weakness is coming, and then everything just turns around and heads back to the upside. And I think that was a lot of, or common for most people's experience during 2015, which I saw on CNBC. They said something about this was the worst year for performance in 78 years, or the most difficult year in the market in 78 years. I'm not sure how they measure it. I finished up a few percent for the year, so Well, I might have been fat and happy last year being up triple digits. I'm happy to be up just a few percent in a difficult environment. And yeah, I had my shots. There were times if I had played things a little bit different, could have done a little better. If you just bought Amberella, back then in June or May to June, maybe you would have made money. But for the most part, uh, just a big choppy sideways range, and your best opportunities seem to come off of the ugly duckling kind of lows, and that occurred throughout the year. It was quite severe in August, but every time the market started to sell off and you saw some leaders coming into ugly duckling positions or down into their lows, undercutting a low, violating a 50-day moving average, at that point they would turn around and head back to the upside. And that makes it frustrating in the sense that unless you adjust and adapt, you're going to be looking for the same old setups that worked in the 90s, and they're not working anymore. And you have to adopt different approaches to the market, and the ugly duckling approach has always been one that I've looked for, looking for bottom fishing pocket pivots, roundabout pocket pivots, undercuts of major lows that might set up a rally. So it's just been very difficult this year. If we look at all the indexes, the Nasdaq 100 has been one of the leaders, because if you look at this, I gotta be careful here. It's actually just kind of been in a shallow uptrend with a little correction in here and running up near the highs. It actually led the rally on Tuesday that prompted IBD to call uptrend resumes. I don't think you can call any kind of a trend at all. So if you want to sit there trying to say the uptrend resumes, the uptrend's under pressure every time at the inflection point, you're not really helping anybody. You're just mouthing off, probably in the service of selling newspapers, but I guess everybody's got to pay the bills. But it's really just going nowhere, So to tell everybody that, oh, it's a market in this or that, there is no trend. And if you look at the broader market, if you measure it by the NYSE Composite Index, what you're really seeing here is an index in a broader market that's been in a correction since May. I mean, it peaked out in May here, and you've been in a correction and you rolled over, you're building this bear flag, and maybe the broader market is telling you where we're headed next year. I mean, the other side of this could be that the broader market has put in enough time for a correction, and this could set up a rally if the broader market kicks in gear. But the other issue here is the fact that the market has mostly been led by big cap NASDAQ names, NASDAQ 100 names, primarily these so-called FANG stocks, and that's where the growth has been in terms of performance, individual stock performance. So it's been very difficult in that sense. And if you look at some of these names now, they're still actually hanging in there. We go with the F in the FANG, Facebook. It's sitting in a base. You can't really say anything but that. It's found support along the 50-day line here. You had a little shakeout in here, but that's understandable given the steepness of this rise. The best buy point was a pocket pivot that we sent an alert out here at 97 back in October as it was coming out of this base, and there was no volume coming out of the base until you got up above the 100 level, but by that time you're already in the stock here on the pocket pivot. And I think this is where you get an advantage over the standard issue breakouts, is that you can get in on a move to a new high, and this is really just a trend line breakout. If you connect all the highs here, you can see that on this day you were breaking out on a pocket pivot and you continued higher. So you got a sharp move and then you pull in and you're just moving sideways, and that's all that's happening. So this could be setting up for a move higher after earnings. The only problem in that case might be that you don't see anything happen until earnings come out, and at that time you'll see a gap up. And we've seen names like Amazon, which is the A in the FANG, gaps up every time they announce earnings. There's one in April. So there's one in January, announced earnings, they gap up. And then they just kind of drift around, gap up again on earnings, and then just kind of drift around. And here you had a breakout, so you had a little bit of upside beforehand. And I think if you had bought the stock in the base and you get this, you might be inclined to sell into that move rather than play earnings roulette. In this case, if you did, you would have been a winner at least for one day, because it gapped up, closed at the lows, and then broke down. Now here's a situation where I think it illustrates pretty well this idea of ugly duckling action, because here you have this break. It's a cascading break, and by cascading it's getting just like a waterfall. getting steeper and deeper as it goes down, and the volume is picking up sharply. So that looks like it's under distribution. You get a rally back up in 3 days. Okay, and you think that, okay, this thing's probably done. You got some resistance here on the underside of this flag, and maybe this thing's going to roll for the 200-day. So you could be in here shorting it, and maybe you're picking up a buck or two here, maybe 10, given that's a $500 stock up here. But it's just chopping around, and then finally it moves out, and you're thinking, okay, it's trying to break out. You got some nice volume right here, and you're trying to break out of this structure. But what happens? It fails, and now it's starting to look ugly again. And here you have a bona fide violation on an intraday basis of the 50-day line. So now maybe it's rolling over and heading for the 200-day, but no, it doesn't. It turns around and it heads back higher. Earnings come out in October and you gap up. This time, instead of going nowhere, you continue moving higher. And then you start to set up sideways, chopping around. You broke out on Tuesday. You're pulling in. Volume is lightening up. Is this a viable breakout? My inclination here to have been to buy on the 10-day line on Friday or Monday morning when we came in. You could see that things were going to rally, and you get a nice trade out of it. And then you sell into that and let it drift back in. Now here it comes back into the top of the base. But with earnings coming out later this month, or actually later in January, I'm already in the new year myself, but still have to get in my quota of martinis for the night. In any case, we're looking at earnings coming up in this. Are you going to sit here with this one and hope that it does the same thing on earnings that it's done the last 1, 2, 3, 4 times? Does Cinderella come 5 times? Do we get another gap up, or does it gap down? Right now, everybody's talking about Amazon as if it's the new holy grail. And that may be its undoing. Now, something to note here is that the stock is hitting the 700 level. Now, if it broke through the 700 level, then you have Livermore's century mark rule kicking in on the long side, with the idea that as long as it can hold the $700 level, it should push significantly higher. As Livermore said, you know, it's good for 20 or 30 points of upside from there. But the flip side of that is that the 700 level becomes resistance, and we know that the century mark can often be significant, not just for the long side when a stock breaks through it and is able to clear and move higher like it did at the 600 level, because we broke through here and quickly moved higher. So you had your 20, 30 points within a couple of weeks. So that Livermore's rule on the long side, the century mark rule on the long side at the 600 level worked. Now you're up here at the 700 level. Does this create another century mark buy signal, or, as we've seen in a number of names that have topped over the past year or two, does this turn into a resistance level, and so it becomes a short sale using the century mark rule in reverse, which is something that I'll do on the short side? So, you know, that's an open question here. It's getting pretty obvious, and I'm wondering, can this thing continue higher? Maybe it can. I think if you test it on the long side, then you're able, you're going to use a 10-day line. So I think Dr. K dropped off. Everybody hears me okay, though, right?
Yeah, no, I'm back. I can hear you now.
Yeah.
Everything's fine.
Somebody earlier was asking you to adjust your mic, but they don't know that you're still in Brazil. So I think the fact that you're able to get through to everybody around the globe while sitting in Brazil and connecting in through my system here on GoToWebinar, I think is quite amazing. And you sounded okay to me, a little hollow. Hopefully I come in a little better. But in any case, you know, you could, like I said, you could test this. This is a valid, you know, by the book, standard issue, base breakout. But as we know in this market, do base breakouts work? Your best bet was to buy it when it was extended. You can put quote marks around that, because I don't ever consider a viable gap up to be extended. You play it as a viable gap up, end of story, and it moves higher. That was when you could have bought it, and that wasn't so obvious on this breakout here, because by that point all the IBD types are telling you it's extended, and it's not. It's viable as a viable gap up, and you could have made some money on that. That would have been your best entry point. Buying this breakout, yeah, a little sketchy. Another point to possibly have bought Amazon recently would have been along the 10-week line. So remember, we want to watch the 10-week and the 50-day lines on pullbacks, because the the weekly chart can get there before you see it on the daily chart. So in that case, you could have bought this pullback at the 10-week line, and you'd be in on that basis rather than chasing the breakout. Because to me now it's a little bit unclear, and I'm not so sure I want to step into this. I'd rather be selling this move ahead of earnings. So maybe it moves higher, but I think you can watch it around the 700 level. Let's go to the N. Oh, Dr. K, you can answer this great question. Is there some public panic due to the Zika virus? Do you know anything about that? I think Dr. K has the Zika virus. Right, Dr. K?
I'm an encyclopedia of viruses. I store them all, and then it makes for a really exciting lifestyle. But I've not heard of that virus. I've not heard of that one. These viral outbreaks, Ebola and whatnot, they're very short term in terms of any damage that they do to the markets. Markets might freak out for a day or two or a week, but then they promptly recover. So, I don't know anything about that particular virus.
Yeah, I think it's the usual baloney where the media blows things out of proportion. It's a lot like we were talking about this earlier. I mean, you're sitting on the beach over there in Ipanema, wherever that is. I guess it's probably pretty beautiful there, and everything's fine to you, right? Go ahead.
It's like anywhere in the world. There's growing social unrest, globally speaking, and that means you have to just be more mindful of pickpockets and petty crimes and things like that. But yeah, no, I mean here in Rio, there's no social unrest that I can see, but I do know in parts of Brazil there are problems. There are problems in parts of Europe, are problems in parts of the U.S. And a lot of these, actually, what's interesting to me is that the real news, the real things, the real insidious things that are going on never get reported or they get covered up. So finally, I do believe the internet, a lot of these major alternative news sites are getting more and more popular because for the first time in history, they said that the majority of people now do not trust mainstream media, and that's the first time we've crossed into that tipping point here. So I think that bodes well, maybe for getting the real news out there to the public, as opposed to all the tainted and false news that the public receives on a daily basis from these major networks.
So no Zika virus for you then, huh?
Not yet. I'll look for it because I like to collect these things, like I said.
Maybe it's hanging out on the beach over there. I don't know. So it's like when we have fires here in Southern California, we get calls from friends on the East Coast and they think the whole state's on fire, even though it's 50 miles away, Anyways, where were we? Oh yes, I was on the A of Fang. Let's go to the N. So we're doing alphabet soup today, and we'll end it with alphabet. So here's Netflix. Okay, Netflix had, if we look at this pattern, we can draw a trend line across the peaks here, and you see this was a pocket pivot breakout right here. You actually had a pocket pivot reversal off the 50-day line right here, and then you broke out on a trend line breakout. That's your buy point. Okay, up here it's trying to break out to new highs. You see that, and of course that's an IBD breakout, and that doesn't work. The new high breakouts just do not work because you're mostly in a rotational type of market, and the strength generally comes from lower in the base. And that just happens time after time after time. And I don't understand why people want to beat their heads against the wall trying to buy breakouts, But in any case, you see the stock pulling into the 50-day line. If you look at the weekly chart, and I've talked about this before, it's a little choppy, okay? So I think it needs some time, if it's going to go higher, it needs some time to set up again. So the pullback brings you down into the 50-day line on the daily chart, but on the weekly chart, it's bringing you down into the 10-week, and it's, on an inter-week basis, it's drifting below the 10-week line. But notice you have this congestion area here from, I'm going to say, late August into mid-November here, okay? Should I use my little drawing tools to point that? Can everybody see that okay? It would be from here, in here, this congestion area here, and you come down on top of it. So, it looks like it's a normal pullback. It looks like you're getting some support. If it doesn't come out here, of course, you've got some issues. It's a little bit of a loose base. It needs to tighten up. You're sort of seeing that here along along these closes in here, kind of tight, and maybe that helps it come out. But again, you got earnings coming out in about 2 or 3 weeks, and I think it's the 19th. I'm not sure. I'll have to check that. But you're going to buy this thing in here. If you are, I think the place to buy it is along the 50-day or along these lows here, using this as your stop. If you're going to buy it, on the pullback. The market's looking a little erratic here. We're down 123. We've been down. What was the low? We're minus 148 or something on the Dow earlier. I'm not doing anything. I'm like I said, I'm up a few percent for the year, and if I'm up 10 or 15, to me that's basically flat. So like I said, I'm not fat and happy, I'm flat and happy, but could have been up more if I had done a couple things right, but I didn't. And sometimes that's the difference, especially the way I trade. So if I hit something big, and I usually play things big positions, I'm looking for a rapid move, and I probably missed, like the Ambarella I missed, and that would have been the ticket, to be big, 100, 150, 200% long, something like that on the run. But for the most part, I'm just sitting here in cash right now, waiting for the new year to start. Turn the mess over to my accountant and let him sift through it. Anyways, getting to the G in the FANG alphabet soup that we're playing is Alphabet, formerly known as Google. The internet stock formerly known as Google. I think they should change your name to that instead. Anyways, you broke out here. Volume's not very high, but you're pulling back. The buy point, though, was the gap move here, which could have been bought. It never violated the low, just like Amazon. Trended a little higher, chopping around. Could have bought it at the 50-day here. But you see how that works, and I'll bet you 10 to 1 that on this day, when this stock hit the 50-day line, the market was looking like garbage. And it's a little bit difficult psychologically to step in and buy something like that. But here's the way you can handle that. First of all, you don't let your emotions guide you. You just look at where the stock is. You understand also that a lot of times the ugly duckling has come into play on these types of moves, on pullbacks. When they look the ugliest, notice it's also sort of running into this low here. So you've got some basis for either using, say, this low or using the 50-day line and maybe a percent or two beyond that as a quick stop if it doesn't work. So you have a reference point to bail. And I think that's how you have to approach it, rather than getting excited about strength. Psychologically, I think if you're an O'Neill-style investor, you've been, say, oriented that way for many, many years, or even if you're pretty new to it, you've been instantly brainwashed into believing that you can buy the market whenever they say it's in an uptrend, and whatever you buy breaking out is going to make you tons of money, and you'll be able to retire and live on a maybe not so small island for the rest of your life. If you're buying into that sales pitch, I think you run into trouble there, but it's easy to do psychologically because it all agrees with you. So this doesn't necessarily agree with you because you're not taught necessarily to buy sharp pullbacks on heavy volume. Somebody said the other day, I heard institutional guy now said that the volume doesn't matter anymore, and that's primarily because it's all machines, and the machines don't pay attention to volume as much as they pay attention to price. So that's something to think about when you're trying to think about the drivers of the market going forward in terms of what the big money is doing, what the big money is looking for. Is a big volume move in one direction something that's indicating big accumulation or distribution in a stock, or is it just telling you that the algos are all running one way, and as soon as they shift gears and turn the other way, the whole thing just turns around? And you've seen that happen many times, which argues for something sort of, I'm not going to say artificial, but mechanistic in that sense, machine-like, rather than humans doing actual accumulation and distribution of stocks based on longer-term earnings. Anyways, looking for more questions here. So we've gone through the FANG stocks. Let's see. Here we go. Somebody asked Dr. K, will it be 1937 again? The Fed rose interest rates or raised interest rates? I like the use of the word rise there, Scotty. That's pretty good. Have you started drinking early? That's all I want to know. So, the Fed raised interest rates and put the economy back into the Great Depression in 1937. Yeah, and then there was a big war shortly after. So is it 1937 all over again, Dr. K?
I looked into that possibility. I mean, I don't, history, as Mark Twain says, doesn't repeat, but it can rhyme. So, sure, it's a possibility that we get a. I don't want to equate this to 1937 in that era, but I will say that that first rate hike could spell trouble for junk bonds and other, and that could have a spillover effect into other markets as well. So. We could also have a situation where, we do know right now that things are not right on a global level at all. And so let's say the Fed decides not to hike rates at all in 2016 and things start to go from bad to worse. They could start another QE program. I mean, who knows? They could repeat Japan. There's a lot of tipping points that this market could go. And we're very uncertain but exciting times. Like I said at the beginning, I think there is going to be potentially enhanced volatility in 2016 because of all these tipping points at which the market sits. One is that the Fed hikes a few times and pops the jump bond bubble. Another possibility is they don't hike anymore, but the global situation starts to weigh in increasingly. And you can see that junk bonds are not doing well at all. They're accelerating the downside. Commodities are not accelerating, but they've continued their downtrends. This Commodity Research Bureau index is at its lowest since, I think, 1973. So those are all major tipping points that could drag down markets and induce a much-needed correction or bear market or even a crash. So again, this is not necessarily 1937, but I think we are at a very exciting. We're sitting at the very beginnings of what could prove to be a very exciting year. With this sort of volatility come ample profit opportunities, but one must be quite nimble and quick. And VIX volatility model is that's the name of the game. There, it is a very quick model, especially when the markets go volatile. So stay tuned for that.
Notice I'm watching Square in real time suddenly taking off. This stock's had a number of pocket pivots. It was holding along the 12 area. We talked about this in previous webinars a couple of weeks ago. We've had some pocket pivots along the 10-day line, and I think we put out an alert here when it had this pocket pivot, and the stock had a little pullback into the 12 area. I think that's where you buy it. Now you're heading back up to the upside. Today it's up 4% right now. That's a nice. Whoops. That's a nice move we're seeing today in Square. I guess did I have my mic off there for a second? But we put this on as a pocket pivot right here and had a little pullback into the 10-day line held here. The 12 price area has been the place to hold, or actually to look to buy shares. I actually been trading it off of that level. Now it's pushing higher, and it looks like it's trying to break out on some pretty good volume for this time of the day. Let me check that real quick. Yeah, make it nice and big here. Gotta change my view. Now 76% below average, so there's no real volume on it right now. It's looking like it wants, I think that was yesterday, so they're pushing on no volume, so watch for this to drift in. So I think if I still owned it, I sold it on this last move up off the 12 level, and if I sell it, I might sell into this. I'm not sure what that's all about. Let's see. Someone points out that maybe IBD should go to trendlessness resumes. I don't know, but that doesn't sell newspapers. I think that's the key here. So, from my perspective, I think everybody needs to remain in touch with the markets. If you're a trader, you consider yourself a trader or investor, there's this idea that, oh, I'm taking a break. What'll happen is you'll take a break, and the market will launch on something nutty one way or another while you're taking a break. So people think that there's especially these days, there's a time to take a break. I think you have to, well, I understand you can pull out of the market and be in cash and just hang out. You still have to be monitoring the market. So if I were going to sell newspapers, I continue to sell them on that basis at least. But I don't know what all these labels are all about. They don't really seem to help anybody. And there is a lack of new merchandise, but you could consider Square to be something that is new merchandise. And it came public here, and now it's popping out. So I wouldn't chase this move though. Again, if you're going to buy this, you want to buy it on the weakness into the 10-day line. That was this morning you had some, so you could have done that. But who's really going to mess around on the last day of the year? So I'm not sure you'd want to buy this strength, especially if it's not on heavy volume. So you'd wait for it to pull into the 10-day again. But again, you have earnings I think coming out at the end of the month, although that's not entirely clear. If anybody knows of the date, I don't think we have it up here yet. There is no date here, and I haven't been able to find it elsewhere. Although for those of you who use MarketSmith or Wanda, you will note that I think it estimates the 28th. So, real quick question here. Nike, yeah, I thought Nike was a short on the. You can hit it in the rally up to the 20-day. This is interesting. You've had a long run, and then you have this big volume breakdown, big reversal. It's a little different than this, which looked like supporting action at the 10-week line. You see that heavy volume down there on the weekly here. And now you reverse off the peak. That was on some allegedly strong earnings report, but that just reversed hard. And so once you rally back up into the 20-day line, I guess you could be shorting this. It undercut this low 5 days ago, and you push back up. So you have a typical undercut and rally, but it could bounce around in here for a little while. This may become a short, and I definitely think it's one you want to watch as it may develop into a short down the line. So I know another one we talked about on the short side, but which it looks like it's trying to go higher. If you look at the overall pattern there on the weekly, it's just a big choppy base. You got a pod over here. Get this out of the way. You got a big pod here, big pod here. This pod breakout failed, and that was a good short sale point. I believe we put it on as a short right here. Talking about it as a short right at the 50-day line, and you had a nice move in 4 days. The type of move you would sell into and take your profits, because you did undercut into this area, these lows in here. But now you had a pocket pivot here that stalled yesterday, and it's moving higher. One of the groups that I like maybe for 2016 would be solars, and I think that you throw in Solar Edge as a battery type play. That might, I think that's had a big, you have a big gap, but it's going to need more work. But I'd keep an eye on some of these, see if they can rebuild their bases and head back up. So I'm watching a number of these. I've traded a number of these. First Solar was a decent trade off the Bible gap up, but now it's roaming around the 10-day line. So Tesla might be more of a battery type play, because there is the whole power pack storage unit thing that's going on with a number of these names, and they are talking about, or the House Republicans in Congress have agreed to a tax credit extension, solar tax credit extension through 2019. Now the one thing that's working against some of the solars has been that the Nevada Public Utilities Commission is making solar users pay more on a monthly basis to cover the costs of the transmission when they resell their excess energy back to the utility. So they haven't had to bear that cost before, and so Nevada made the move towards charging more for that. So that changes the economics of solar rooftop installations. So Solar City announced that they're pulling out, and that stock got hit, knocked down. You had a nice move. You could actually bought this Bible gap up right at the 200-day line, and then it runs higher, and you pull back into the 200-day now. But that's been hit on that news. I'm not sure if that creates a buying opportunity. The other one to look at that people have talked about is Run, which is an IPO, and I guess you'd call this a big double bottom, breaking out, but pulling back in. That's a little bit of straight up from the bottom of the base. You're not going to buy that and expect it to just break out and launch. So you got to watch this pullback. Maybe it comes into the 20-day, and maybe it sets up again. But I think that some of these the market's coming back now. That doesn't surprise me. Some of these may set up and go higher, and so I'd watch that. So the other one is SunPower. along the 10-day, and these are names I'm watching for 2016. If oil starts to come back, the price of oil starts to rise again, I think you could see solar benefit from that. That would give some impetus, but the tax credits being extended could provide another impetus, and that might be more favorable to names like SunPower and First Solar, which have been a lot steadier. Solar Edge also has been a little bit steadier in terms of holding up. Solar City and Run, which are rooftop installers, are a little wilder. So somebody says, if there's a bond meltdown, as Dr. K suggests, could happen, would the market go down hard because of huge margin calls? Well, I mean, anytime you get huge margin calls in one asset class, it could affect the rest of the market. So, sure, it could, but I would say just watch the stocks. I think one thing I noticed, people talk about a bubble bursting in junk bonds. If we look at the weekly chart, didn't it already burst? I mean, hasn't this been a pretty sharp breakdown here in 2014, and then this year you've had it continue to burst? So hasn't the bubble already burst? That's what it looks like to me. Maybe it goes down further, and maybe it's really going to burst, but who knows?
If you look at 2007, it's kind of retracing what it did then. It started to rupture in 2007, and then it was, I think it was in September. Yeah, it was in September of 2008 that it finally just gave ground and flew apart. So that's the concern right now, is that we have a fairly long-term downtrend in junk bonds that started in 2014, and some have speculated maybe perhaps it's going to start accelerating. Together. But again, to say it's going to repeat 2007 to 2008, that who knows? You got to just watch the market day to day. And the Fed raising rates is not going to help the situation.
Getting back to Square, I was just checking the projected volume on this here. Let me see if I can. I have another one. Yeah, you can see if you look at this. Let's blow it up. I think this is a great feature, actually. You can see that the projected volume based on the rate of change, even though it's minus 45.9 right now for this time of the day, it's still accelerating, and it's projected to post another pocket pivot. So you might want to take note of that, Dr. K. But again, I'd be buying this off the 10-day rather than looking to buy into strength. So interesting, though, that it decides to get going now. So now we see the market coming back. We're down 74 on the Dow, roughly. And you're popping a little bit, so looks interesting. Somebody says, how can you spot intraday turning points? Well, I've been talking about this basically. On an intraday basis, you just watch where the stock is trading on the chart. One thing that I look at, and I keep this screen, let me show you what this screen looks like normally for me during the day. I don't really watch the indexes here, but I do watch. I have a list of names, and I can throw in new names and whatnot in here. I got the market over here, and I will just intraday. I'll be looking at the weekly and the daily charts at the same time. So I put them up like that, and names that I'm watching, I can just simply scroll through very quickly. So you can see that Facebook hit the 50-day line. You could have bought it right there this morning, but again, see the market's down 140, 150 points. It's looking a little ugly. It's the last day of the year. Do you really need to step in and buy it? Probably not. But I'll be watching the stocks. So you're seeing this intraday as it's bumping up earlier. Probably if I wasn't doing this webinar, I could have picked it off there if I was focused. But I'm not really looking to do anything today. I'm just chilling. And you look at the pullbacks here. You can also use a 620 chart. So. That's not the 620 chart. Where'd you go, 620 chart? It ran away. Here it is. There we go. Let's get him out here. Tends to be shy. It hides in the back. You can also look at potential turns here on the 620 chart. You're just starting to get a buy signal on Amazon. That's one way. You're pulling back to this level here, which is about 680, I'm guessing, right around here along this line. and the top of the base, which is maybe 683.84. What's the high here? 682.50. So as you're coming into there and now you watch it turn, you can use the 620 chart. But I would be careful. I noticed in the last few days the 620 chart will show a bottom and it'll turn and you'll get a cross here. You can already see the MACD cross before off the lows. You probably would have been better off if you're using the the pullback. If it coincides with a cross in the MACD here, you might take a shot there a little bit lower at 683. But that's one way that I'll pick off bottoms. I'm watching all of these charts and trying to corroborate between the three of them where there might be support coming in and whether the stock is turning. So if I want to come after Amazon here, you could do it on the basis of the 620 chart using a 620 sell signal to bail out. But what I've noticed over the last few days is you'll start to get a turn and then it'll roll back over and then it may just continue lower, or it'll give you a turn later on in the day. So you have to be a little bit flexible. But if you're giving yourself, once you take a position, if you're giving yourself a 1, 2, 3% stop and you're near a level of what you think should be solid support, then you're roughly in a good spot to sit through it and see how it plays out. So that's how I'll come after inflection points, and I just keep this up all day long and just run through my names during the day. Every 20 minutes, every 5, whatever. Just pop through them, and we can see the Netflix coming in right at the 50-day, and let me see, I'm going to push this back just a hair. You can see that you got a cross here on the 620 here. So these are good for trades. You'd be up a few cents, but it's giving you a sense of where the turn is occurring right at the 50-day line. It's coinciding with a 620 turn. You can take a shot because what's your stop here? The low at 115.61 today, or you could use the low here, another percent lower, so at 113.85. So that's how you can find inflection points intraday, and that's one of the things I'm always looking to trade on. And I'll come in and swoop in and pick up a position and then see if I can run it up higher. I did that yesterday, and that was good for a little bit, a few points or a point or so on some names, and it's worthwhile sometimes in terms of finding the lows and the turning points on an intraday basis. So somebody asks, is your 620 chart an HCSR chart? Does that look like an HCSI chart? That's an E-signal chart. So HCSI doesn't have real-time data, so you're not going to get real-time charts. So the intraday chart has to be done in your quote system, I think, unless you have something else that's real-time. Most of these services like free stock charts, I think Warden, HSI, they're delayed a little bit, and so you want to be watching a real-time intraday chart, and the only place you're going to get that is on your quote system. So this is E-signal. And you're seeing this starting to move. So see how that works, and it's off the 50-day. So I look at this all day long, and I make it nice and big, because while I'm still young, I like I don't have the sharp vision I used to when I was in my 20s, and I like to look at big quotes. Bill O'Neill used to have his big quotes set up. His quotes are actually bigger than what I've got here. These are pretty good size. But I can just pop through everything. You can see Alibaba hitting the 50-day, and this one looks like it might be setting up. This is a name to watch for next year. If Amazon is so hot, and they're in a lot of areas like the cloud and whatnot, and Alibaba's looking at moving in that direction, there's still strong growth there. And they've still got the Chinese market, which is still huge. Regardless of what the economy is doing, we'll see how that progresses. But they're now talking about putting out their own QE, so that could make things interesting. But it's setting up. So here it comes into the 50-day line, and what's your low here? 81.42. So you're 20-something cents, a quarter point off of your low for the day. So is this the end of the world here? I don't know. We'd watch this here. Let's watch it at 620. You just got a buy signal. So, this could try to turn here on an intraday basis. So maybe this is a spot to buy it. I think I'll visit it maybe on next week. I don't want to carry anything over the long weekend, and I generally push everything to cash anyways for accounting purposes. So since we use mark to market. Anyways. Warden has real time for about $10 a month. Well, that's good. So you could, but you don't need that for an intraday chart. You can just, if you use eSignal or whatever your quote system is, it should have intraday charts. I know that I use the Schwab platform, the Schwab Investor's Edge or something like that. I forget what it is. Street Smart Edge, yeah, that's it. And that platform has real-time intraday charts. So, you know, that's all you need. But yeah, Warden, I guess if for $10 a month you can get real time, I think you can also get it on MarketSmith. HGSI will get there, but again, I don't think Warden gives you as much visually as HGS Investor, but I have to say I haven't used it in a long time. I used to use it way back when I was a broker, and it was a daily download. You know, that was a big deal though, because before that I used to make copies of my daily graphs charts on the weekend, and then during the week I would keep them all in a notebook and I would mark them up with pencil to put in the new days during the week. So I had a real-time chart, and then when I got my Warden Brothers Telechart 2000, I think it was, you update that at the end of the day. It was awesome. Okay, so where were we? Any questions? Any more questions? Pocket Pivot, PPV, and Celging. Well, I think you had a viable type gap up. I think this stock's going to go higher. See the pullback this morning, or actually the other day, I'm sorry. You pulled into the 200-day and the 40-week on the weekly. See how that held? And that could have been bought there. This looks like it wants to go higher. So make a note of that. And I'd watch all the biotechs because they might make a comeback in 2015. I think that's a possibility too, because again, you've had this rotational market. That's why I'm looking at some of the solars. I don't know about the oils just yet, but the biotechs, it's still a very strong area of the economy in terms of baby boomers getting older and the demand for various drugs and illnesses, and a lot of the great stuff that's going on from a scientific perspective, you know, the new products and whatnot. So, you know, you watch some of these biotechs, they may be on the comeback trail. But yeah, that looks good. Anything else? Let's see. So, you know, in general, I guess we're gonna put out a year-end piece, but I think for next year, I'd be watching a comeback in the biotechs, a comeback in the solars, if we don't get a bear market. And I wouldn't make an assumption either way. All we know for sure is that the market is in a big sideways, choppy trend. That's what 2015 was. Is that setting up further upside into 2016? It could be, and I wouldn't discount that possibility. I'd say watch the stocks and play the charts as you see them. I don't get into developing macro theories necessarily as much as I do watching the charts. And again, remember this ugly duckling concept. I keep pushing on this chart here. Here we go. When things look grim, you know, that's the time to step in. And Facebook this morning hits a 50-day almost exactly 105.13. What was the low? 105.21. So you came a whole 8 cents away, a teeny away from a little more than a teeny from the 50-day line. You're right off it. So you know, you could take a shot there, and that's kind of what you have to do in this market. And I think I talked about that a couple of weeks ago, that you have to take a contrarian view into weakness and conversely into strength. You buy into weakness, you sell into strength. And in a choppy environment, you know, that's basically trading the channel. And you're able to profit that way. But if you're going to enter stocks, I think you really have to look at using weakness. Look at this square go. You know why it's going higher? Because I sold it and took a small profit there, and now it's just going to launch on me. And on the last day of the year. So that, you know, that's the way that works. But you know, let's be real. If this thing's going to have a real move, it's going from here to 50, you know, or 20 or 30. So I think this might just be the beginning, but something's got it moving today. Any news on it? Anybody know? Yes, Square, we already pointed that out, that you're projected to have a pocket pivot. I don't know if you guys can see this. I'll try to make this really big. Really big. If you can see this greenish, you see the blue is the volume so far, but you see this green, glowing green, neon green line, that's projected volume for the day. So when I go through my charts, I can see very quickly if something is trading at volume for this time of the day, that might imply a big a volume spike, or at least a pocket pivot spike. And you can see it's already coding blue in anticipation of this. So it's very easy for me to see this. You can see all the pocket pivots, both 5-day and 10 days in here. It's had a number along the lows, and selling volume has been relatively low. So this might be a new name to look at in
Uh,
2016. Go ahead.
Yeah, I think it's just retail volume. I mean, the volume's not overwhelming, and I think,
No.
like we said, you can get moves in this kind of low volume environment, and I think a lot of people see it. So a lot of retail investors are looking at the name, yeah, and that's pushing it higher.
Yeah, I mean, that's a possibility too. So other names I'm looking at, you know, Match might be something interesting to look at. Its IPO hasn't gone anywhere. There's another one, Team. It's an Australian company. They're an interesting story. I'd check into that one. I think that might be interesting. I want to look at real quick the Gilead hanging out. Celgene is looking a little better. You see that? That's looking pretty good, and you're going code blue here. So that's, I like this, the look of that setup right there. That looks pretty good. Maybe I'll come after that on Monday, but like I said, I'm not looking to do anything today. Somebody's asking a question. You said in a recent webinar that in 1999 there was a huge influx of new retail investors in the market. I think that was the case throughout the 90s. You were seeing it just build up, and the other influx was due to baby boomers who were moving into their 40s and, well, let's say their 40s if they were born in 1950. So they're into the 40s, between 50 and 60 basically, late 40s. Yeah, so yeah, moving into the 40s and maybe early 50s, starting to save for retirement, although I think that's a little bit late. Should have started saving when they were in their 20s. But in any case, there was a big influx of baby boomer money coming in to the market, and household ownership of equities was at a low, I think, coming into 1990. And so that was at an inflection point, and then you saw the percentage of household assets in the stock market increase quite a bit between then and 2000. So yeah, there was an influx of retail investors, and I do believe that there has been an outflow since, say, the mid-2000s, and you're not seeing as many investors. So there's also the potential for more people to come into the markets, given that you've seen so many flow out. So there's a lot of dynamics here. I think 2016 will be an interesting year, given that it is an election year, and I think we're set for some major change. It could be positive. I do think that there are a lot of positive areas of the economy, from biotech to the cloud to handheld devices, still drones. There's all sorts of themes out there, I think, that may still be big. Cybersecurity, I think, could be another area to look at as a comeback group, because a lot of these names have been hit. And you see cyber, it looks to me like it may be trying to make a comeback. Palo Alto Networks, see right at the 50-day line, it's pulling in. Maybe it's just building a base in here. So I think that area could be strong. So there's a lot of strong areas in the economy. If you take the lid off of it all, it could go nuts on the upside. So that's what I would be looking for. Anyways, but that's all I've got. I got to get going. So Happy New Year, everybody. I think next year is going to be a lot more fruitful, and we'll see how things pan out. So everybody stay safe and sane tonight, and we'll catch you next week or next year.